What is quantitative easing? What is QE and what is the purpose? Okay, so great question. So let's go through this. So quantitative easing is when a central bank buys bonds from the market. Okay, but what does it actually do? QE, Kishkor says, is QE the same as asset purchasing? Yes, typically it's them the central bank buying bonds, but if it's asset purchasing, they could be buying other things too. But all of this is actually pretty new, and even quantitative easing was a brand new thing. When I started trading currencies, I don't know, 15, 20 years ago, there was no QE. We were even debating whether inflation targeting was even something a central bank should do. So anyway, so what is quantitative easing? So let me explain it this way, okay? To do so, we're going to need to do some economics. Oh, I'm sorry, I know, economics. All right, let's do this. So you have the price of money, and you have the quantity of money, okay? And we have a demand curve that slopes down, meaning when the price is high, you don't need a lot of quantity, okay? If you could buy a Porsche for $1, if you were $10, if you had $10, you'd be rich, right? If the price, right, or purchasing power or the value are all different words, right? If the value of $1 is low, you're going to need a lot of quantity. Okay? No, this isn't 1 over R plus E. Okay? That's the money multiplier. Okay, on? Okay, so anyways, this is if money is powerful, you don't need a lot. The Q would be low. Okay? If the purchasing power of $1 is low, you're going to need a lot. Okay? You got that concept? That's why the demand slopes down. And then what direction does the supply of money slope go? If the demand slopes down, what's the slope for supply? Give me a direction. Pierre says up. Or sorry, opposite. KG says up. It slopes up. Right? No, wrong. Okay? It's vertical. It's not up like a traditional supply and demand. It doesn't make an X. The supply of money is the amount of money. It's finite. It's like that's how much money is in the economy. That is the supply of money. That is it. It is that. That is it. So it's not like supply and demand typically creates an X. There's just that amount of money. That's all there is. Okay? All right. So there's the supply of money. Okay? So now I have to label the chart. Because remember, a good boy always measures, right? Money, supply. Okay, so let's talk about this. The Fed does quantitative easing. We know quantitative easing is them going into the market and buying something. What they do is they buy a bond. Where do they buy the bond from? Where do they buy their treasury? See, a treasury is simply a government bond. You can buy a corporate bond or you can buy a government bond. A government bond is a treasury. So quantitative easing in this case is the Fed, the central bank, buying a government bond. In the United States, I believe there are only 12 bond dealers. So if the Fed called up the Treasury, see, the Treasury is the one that creates the government bond. And if the Fed bought the government bond from the government Treasury, then the government would get money and the Fed would get the bond. And nothing would change in the supply because it just goes to the government. So that wouldn't have any effect, except the government would owe the Fed an interest payment, right? Okay. So what is the point of quantitative easing? Well, the government is trying to support the economy. In fact, we were just looking at the Bank of Canada statement. That's where this question came from. The Bank of Canada is continuing quantitative easing program, large-scale asset purchases of at least $5 billion a week of Government of Canada bonds, Canadian treasuries. But also it says somewhere else, as the economy moves from reopening to recuperation, it will continue to require extraordinary monetary policy support. Quantitative easing is extraordinary monetary policy support. They're supporting the economy. Okay, they are supporting the economy through monetary policy. So let's figure out what that means. The Fed, in this case, let's talk about the United States, but it could be like the Bank of Canada is buying bonds, but not from the Canadian government, but from a Canadian bond dealer. The bond dealer calls up the government and says, we need to buy some government treasury. So in this case, the Fed calls JP Morgan. The JP Morgan calls the U.S. government treasury and says, we need to buy $1 billion in treasuries. So, right? So now JP Morgan buys the treasuries. They have less cash on their balance sheet than they used to because they gave the government the money. They loaned the government the money. So they're short cash. But now they own this asset. They own the government treasury. But that's not what JP Morgan wanted to do. What did JP Morgan want to do? They wanted to sell that asset to the Fed because the Fed called them up and said, can you get us some government treasuries? They're like, sure. So what they do is they mark up the price, essentially front running, right? And they sell it to the Fed. The Fed just calls them up. We'd like to buy $1 billion right here, right now. So JP Morgan says, not a problem. Hang on a second. They pick up the phone on the other line, call the Treasury. Okay, we'd like to buy $1 billion of U.S. government bonds. The government says, sure, not a problem. JP Morgan transfers money to the government. The government transfers this bond. It's just a piece of paper that says, on a certain time and a certain date, we'll pay you back. Okay? Then JP Morgan then picks up the phone again with the government on, or with the Fed on the line saying, we got your treasuries. We're going to mark it up. You're going to pay a commission, basically, and we'll sell it to you. Well, why would they do that? Well, okay, remember JP Morgan now. JP Morgan. Okay, they have assets and liabilities. Okay. Okay, so they used to have cash. Okay. But what happened? Cash went down 1 billion, but they now have 1 billion in bonds. The bonds went up 1 billion. So the assets on the balance sheet haven't changed. Cool. So what happens next? The Fed clicks a computer key and goes click, 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 click. Okay, we have $1 billion now, right? Plus 100 million more. So JP Morgan sells the bonds to the Fed now for $1.1 billion. The bonds go away from the balance sheet. Okay. And JP Morgan gets an extra 100 million in cash commission or whatever, right? And so cash goes up. The supply of cash actually goes up. But the interesting thing is, the billion never existed. Okay, so anyways, let's get away from this. The point is now, instead of the Fed giving the government money, the Fed bought the bonds from JP Morgan. They created the money. They didn't print it. That's what the Treasury does. The Treasury prints dollar bills. The Fed created, they actually, with a keystroke, created $1 billion or 1.1 billion or whatever. And they bought the bonds from JP Morgan. So now you look at the Fed. Okay. And the dealer, JP Morgan. Okay. So the Fed gave the dealer cash, and the dealer gave the Fed the bond. You see this? So now the Fed's balance sheet has gone up. Right? Have you heard that? Like the size of the Fed's balance sheet. Do you ever hear that in the media? What are they talking about? How many bonds does the Fed own? But they give the bond dealer the cash. So now the dealer doesn't have the bond, they have the cash. That goes into their bank account. Okay? You know what's clever? Is 10% of that money goes back to the Fed because it's required they keep that money at the Fed. Right? So let's say 10%, 100 million. So let's say now they have 900 million left, 100 million parked at the Fed. And this is where your 1 over R plus E comes in. But you'll have to take the fundamentals course if you don't know what the money multiplier is and all that. We're not going to go into that today. Okay? All right. So I just want you to understand that it's the Fed creating money, not printing money, creating money, and why they don't buy it from the government, but instead buy it from the bond dealer. And now the money now, the new money that the Fed created is now in JP Morgan's bank account. And JP Morgan is in the economy. Okay? So, check this out. So the amount of money has gone up. The Fed created it on their computer.
Less dramatic than the stress test scenario from April.
I knew it was open. Where is it? Hang on, I couldn't find it. Live streaming. No. Where is it? Baltic Dry Index, Forex calendar. I don't know what screen it's on. It must be this one. And sure enough, there it is. I had it covered by... Okay, so let's get back to this. Okay? All right, so the government doesn't buy it, the Fed doesn't buy it from the government because they would just go into the government and that's that. So they allow JP Morgan to front run them, and JP Morgan buys the bonds, and then the Fed gives JP Morgan the money, and now it goes into JP Morgan's bank account. But don't worry, they end up lending it out. They're banks. That's what they do, is they lend their money out. Okay? And then it goes into the real economy, and eventually it goes into your mortgage, and then your mortgage goes to your broker, and your broker goes out and buys a used BMW and whatever, and then the car dealer gets money, and then it just goes all the way through, and the car dealer buys lunch, and the waitress at Applebee's gets money, and she goes out and buys groceries for her baby, and it trickles down. Okay, it just trickles all the way down over time. But what we do know is the reason Fed was buying treasuries was to put money into the economy. That's what quantitative easing does. So now check it out. The quantity of money went from supply 1 to supply 2. Always label, okay? So what's happened? Well, we used to have an equilibrium price of, we'll call this P star, okay? And then we have a new supply, okay? Equilibrium 1, equilibrium 2, and price went down. See what happened? The increase in supply, so quantity 1, 2, 3, 4, 5, 6. So we went from 6 quantity to 8 quantity. So now let's call it like, so JP Morgan bought 2 billion, or the Fed bought 2 billion from JP Morgan. Okay, so we went in billions or whatever, right? So the supply increased and the value per dollar, or purchasing power per dollar, fell with the increase in supply. The 10x comes from 1 over R plus E. Okay? So again, if you are interested in this kind of thing, if you go to fxbootcamp.com, join, and like you guys, as you should know, it's almost 80% off right now because of COVID. In the fundamentals course, by the 3rd or 4th hour, you're managing the balance sheet of a commercial bank. And then once you're able to do that, I can take you through these types of lessons so you understand how to manage the balance sheet of a central bank to get the outcome. So now what happens here? Well, the value goes down, so you need more money to buy stuff, which pushes up inflation, or stimulates you to spend money. So one way it stimulates is interest rates, its impact on interest rates. Well, if interest rates are low, there's no reason to keep your money in the bank because you're not earning any interest, like, or hardly any interest. So you're like, well, I got $1 million, but I earn like $12 a year in interest. So like, maybe you should invest your $1 million. So you okay? And that's what they're doing. This is when these decisions are made, like if you earn $0.25 by putting it in the bank, but the stock market goes up 20% a year, okay? Which one are you going to do? If you leave it in the bank, you earn nothing. If you put it in the stock market, you earn 12, 13, 14, 15, 20% a year. So you're like, well, I can't leave it in the bank account because you need 2% minimum to live, right? And the bank is paying you 0.2. So you're like, well, I can't leave it in the bank, so you have to invest. Where do you invest? The stock market. Okay? That's why the stock market goes up. And why does the Fed want to do this? Well, first of all, they want to increase asset prices. Again, what's an asset? Real estate? Your retirement account. Okay? The reason they're supporting the economy is they're trying to get asset prices up, which is a form of inflation, which is they're fighting deflationary pressures. So the stock market has to go up, or QE is designed to push the stock market up. It's designed to push up housing prices, which then pushes up consumer spending. And your spending is someone else's income. And when your income goes up, jobs are created and more spending because you feel good about your job, your house price went up, the stock market went up, so your retirement account is up and you feel good, so you do more spending, which is someone else's income, which creates jobs, which creates more spending, which creates income. And if you don't own your house and if you don't have a retirement account, you're poor and you will stay poor. But if you have a little bit of money and you have a retirement account and you own your own home because you have a decent job or you're a good Forex trader, then think of it this way. The Federal Reserve Bank of the United States does whatever it takes to make you rich. Now, a lot of people will bitch and complain. They're like, well, that sucks. That's for the top 1%. This is all rigged. Well, then why don't you get a good job and have a retirement account in the stock market and own your own house so that the government makes you rich? Like, get in the game, right? Don't hate the game, be a player. It's the quantitative easing is designed to increase asset prices. So what do I preach and preach and preach and preach? What did I preach about like just a few days ago? For like 2 hours, I didn't even do Forex. So I just preached. I said, you need to own assets. Because when things get bad, the government will do whatever it takes to make sure the value of your assets go up. You need to own. You need to be an owner. You need to be a boss, right? Bosses own. They have power. You need to own assets. Real estate and stock, easy, right? You own your home? I own my home. Do I have a retirement account? Yeah, I'm contributing to it today. Why? Tax-free compounding. Tax-free compounding. And do you guys remember I explained to you just the other day too, if you own your own Forex trading business, you can pay yourself before you pay the government. If you defer, like you can't just like take 50 grand and go out and buy a used Mercedes. You'll have to pay taxes first. But if you say, I'm going to defer my pleasure, I'm going to put it in a retirement account, I can do the $50,000 before taxes. It's like you never made the money. So now you put it in an account that grows 10% a year for 30 years. And then you're like, how much did your 50 grand grow? And then in year 2, 50 grand, year 3, 50 grand, 50 grand. And I know when things get bad, the government's going to bail me out. Why? I'm an owner. I own assets. And they're like, oh my God, we gotta push asset prices up. Damn right you do. Right? So that's the game. Like, you can't hate it. Be a player. Don't hate the game. Be a player. You should, right? So anyways, whatever. So this is what quantitative easing does, is it's the government supporting asset prices by increasing the money supply, lowering the value, which means it creates stimulation. It lowers the interest rate, so you have to invest. You shouldn't save your money, right? You shouldn't be in cash. Cash sucks. Cash is horrible. You got to deploy your cash and buy an asset that will go up in value and create income for you, passive income. So, and then when things get bad, the government will bail you out. Oh my God, that's beautiful, right? So that's what quantitative easing does. If the central bank simply bought it from the government, that's not cool. It just doesn't do anything for the economy. If they buy it through the bond dealer, they put the money into the economy, increasing the supply, shifting the supply curve to the right, lowering, because demand will be the same, lowering the value, creating inflation, also making exports more competitive, right? Forcing every American with a savings account to get their money out of their savings account and into the market through investment. Then driving up demand for assets like gold, real estate, and more stock market. And then all of a sudden you get in a situation where we're in a horrible, 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 horrible economic crisis. And if you're in the stock market and if you own your own home, you're filthy, stinking rich. This is a great year. If you bought in March and April, some stocks are up over 100%. You've doubled your money. Why? One part of the why is quantitative easing. This is what the Bank of Canada is doing and many other central banks. But what's the other part? What really happened? Okay, what really happened in the this more recent recovery? Was it due to quantitative easing? No, it was the effect of quantitative easing. And again, like I'm saying, if you're trying to live, if you're retired and you're trying to live off 2%, right? And the bank is paying you 0.2%, right? Then you are forced to invest your money by either buying bonds and stabilizing corporations, corporate bonds, or exposing some of your portfolio into stocks, pushing up Apple, pushing up Facebook, pushing up Google, pushing up Zoom, pushing up Netflix, so on and so forth. Because you can't save. You can't. You cannot. You're like, I cannot be in cash. I cannot be in cash. I cannot be in cash. I have to get into the market. Okay? I have to own. And because you're forced to do it, you have stock markets at all-time highs because there's nowhere else to put your money. You have to deploy your capital. You have to own shares of corporations or lend money to corporations through bonds or own real estate, for example. Either own your own home, which goes up through amortization, right? And appreciation. Or you invest into like something that you can collect rent on and have income. Okay? Not just your mortgage falling and the neighborhood prices going up, but actually earning income on top of that, right? You are forced to do it. Forced. Which means everyone else is forced, which pushes up asset prices. So if you weren't buying in 2008, and I begged people, right? Or even in March, remember? I'm like, create your list. You cannot save your way into prosperity. You guys remember those conversations? You cannot save your way into prosperity. You have to own. You got to buy when prices are down. You got to own something that will go up in value. You got to own something that will provide you income, because the more income produces, the more it's worth, and the more the price will go up, which is this virtuous cycle. Or you got no money, you got no car, you got no woman, and there you are. I think that was Plato, wasn't it? Or Confucius. No, Confucius doesn't rhyme. Anyways, I think you got it, right? So, increase of supply, lower price, lower value, which changes your behavior into pushing up asset prices. So the moral of the story is you need to be an owner, not a renter. You need to be an investor, not a consumer. And ultimately, you won't work for a job. You will own cash flow. And your money will work for you. And you will not work for money. Very cool, right? So I'd like to thank the person that asked the question, what is quantitative easing? That's what I think it is. Yep.